All right, welcome back, everybody, to this week's State of the Market. I'm your host, Seth Golden. This is Finom Group, and I'm going to dive right into it this week. Got markets continuing to hit new all-time highs here. What you want to do, stay the course. I mean, if you've been watching and monitoring the weekly economic data, I mean, it's just blowing estimates out of the water, economists' estimates. And this week, just today, we got stellar retail sales, which was to be expected given we're looking backward at March's retail sales when everybody's got their stimulus checks and more people are going back to work. And when you look at the year-over-year comp, well, when did everything shut down? It shut down last March. So the year-over-year retail sales growing above 27%. Again, these are anomalistic numbers, that are derived from a very low base, even on a month over month. And that's why in that context, you look at the retail sales more, as a reflection of the current trend. Month over month was up more than 9%. Again, you do have the benefits of the stimulus checks, but we shouldn't discount that more and more people are getting back to work as more and more people are vaccinated and they feel confident going back to work. All those job listings that have basically been vacant for several months are now being engaged by the workforce. With that said, initial jobless claims dropped below 600,000 reported this morning. So again, markets are reflecting that more than likely economists have underestimated the economic growth going forward. Having said that, nothing really should change in your game plan, folks. Stay the course. This is a new cyclical bull market. There's going to be bumps in the road. We saw a bump in the road just yesterday, right? But yet we bounced back here today with the Dow all-time highs, small cap growth, the Russell 1000 all-time highs, equal weight S&P 500 all-time highs, cap-weighted S&P 500 all-time highs, NASDAQ 100 all-time highs. Again, folks, stay the course. Have the right expectations. There's going to be bumps in the road. There's going to be setbacks. We'll talk about some of those setbacks here today as well, given the feats of strength the indices have performed since the COVID bottom or the March bottom in 2020. One of the things that kind of popped into my head recently, this is a tough week for your boy, by the way. So if I'm a little bit off today on this week's State of the Market, bear with me. The most hopeless situations deliver the most valuable opportunities. And I think that's so indicative of what happened last year, be it in the stock market or just in people's lives. We had this opportunity, possibly this once in a generation, if not lifetime opportunity, to really come together and unify as people, to really take advantage, thinking as an investor, thinking as a trader, to really take advantage of possibly a once in a generation, drop of 35% in the market. As I always say, those kind of hopeless situations tend to be the most valuable opportunities. It's true in the market. It tends to be true in life. It's true in my life. Again, this is a difficult day for me, but I'm somebody who came from a really difficult childhood. And in that, I made it that much more difficult on myself. Just terrible behaviors. I had, some behavioral disorders, hyperactivity disorders. But as I got older, as I matured, it still came down to me. I had two paths that I could take. One that would lead me where many of my high school teachers thought it would, which was either jail or dead by the age of 25. Legitimately, they would express this to my father in parent-teacher conferences, which they probably shouldn't have, or there was the other path. I chose the other path consciously. it took conscious because I, suffer from some, hyperactivity disorders, lacks of concentration, and things of that nature. It took a conscious decision. It took discipline, and it turned out well. But my hopeless situation was an opportunity. And I've carried it forward into my adult life, and now as a husband and as a father. So it's in those darkest days, as they say, those darkest days where, if you find yourself not succumbing to the pressure as we were in the markets in March 2020, if you didn't succumb to the pressure, if you didn't give up, if you didn't hit that sell button, you stayed the course, there were brighter days ahead. Bottom line, there were brighter days ahead. And you caught a very valuable opportunity. So fast forward here to the present, 2021. As I was gathering the notes for this, we had 22 new highs already in 2021, as this chart indicates. Actually, this was starting on Monday, and we had 21 new highs. Tuesday, 22 new highs. Here we are Thursday with our 23rd new high of the calendar year. They tend to cluster. That's the point here. They can go on for a decade, if not more. They tend to cluster. So if you think the end is near, just because price is at all-time highs, it's just the wrong perspective. Historically, that is not the case. Historically, you're going to continue making new highs. Maybe not Friday this week. Maybe not next week. Maybe we finally get a bit more of a pullback. But eventually, we are going to make new highs. The breadth is there. The sentiment is there. The economic data is there to carry the earnings that much higher throughout the course of this year. It all adds up. Those are your puzzle pieces, and they all fit together very well. This chart right here, what could a strong Q1 mean for the rest of the year, right? We had a very strong Q1, folks. When the Q1 period has a gain of 5 to 10%, that's kind of been the sweet spot for returns going forward. The S&P 500 index was up just under 6% in the first quarter of 2021. Looking back since 1950, when the S&P 500 was up between 5 and 10% in the first quarter, the rest of the year gained another 12.4%, as you can see right there, up another 12.4% on average. The best part of that number is not just that double-digit return the rest of the year or the next 9 months of the year, but the positive rate. The percent positivity rate is 86.7%. I mean, going back to 1950s, only 1956 and 2011 were down years after you've had a between 5 and 10% return in the first quarter of the year. Only twice. Pretty awesome. And that's a good sample size here, folks. The sample size is important, but also the years that are represented. Like, we want some of those modern, market years, like, after 2000, and we have 2011, 2017, and of course, in the present. It's important to, flesh out those details. You want your sample size not only to be robust when you're studying historical data, but you also want some occurrences after 2000, because the market has changed. In my opinion, you also want occurrences that include the FANG era, right? FANG has changed a lot in this market, folks. It really has. They constitute a majority of the earnings. That means something. That carries a lot of weight. All right, this chart here, the December low indicator. This is another indicator or breadth study, if you will, on the strength of the market after, going into a new year through the first quarter. So what this particular, the December indicator says, the December low indicator was created by Lucien Hooper, a Forbes columnist in the 1970s, and simply says that if the S&P 500 closes beneath the December low during the first quarter of the new year, then future weakness could be in the cards. But if this critical level holds, then higher prices could be around the corner. As the LPL chart of the day shows, stocks held above the December lows in 2021, and this could mean continued higher prices, as the S&P 500 was up more than 18% on average in the previous years when that December low indicator held, up at 18.4% on average. You don't like the average, you want to, temper your expectations. 17.3% was the median. Again, look at the percent positive rate, 94.3%, folks. Again, this is just one of those. This indicator is very much like the toy barometer, the turn of the year barometer, which measures, I think it's November 19th of the past year to January 19th of the new year. It's very much like that one. So, again, only twice, 2011, there's 2011 again, but look at the decline. I mean, it's basically unched in 2015. And that is a very robust study with a lot of, post-2000 occurrences here. Good study, folks. Here's another one. Big yearly gains tend to resolve higher, not lower. Everybody's looking, well, we've gone so far so fast. We've come too far. We're up 80% plus from the March low. So big yearly gains tend to resolve higher, but it can be a little rocky. You can get pullbacks for sure, and that is what we should anticipate, if not expect. But it's nothing to be afraid of. S&P 500 was up nearly 54% in the 12 months ending March 2021. One of the largest yearly gains ever. Looking at previous times that had significant 12-month returns shows the potential for weak returns 1, 3, and 6 months later. As you can see here, next 3 months, nothing. When you've had this size of a gain or better or around that, there's 36, 37, 50%, 53%. Like this is the most almost. Based on all of these studies, this is the biggest 12-month return. The good news, however, even though this can be very choppy, lackluster returns, the good news is 1 year later, the S&P 500 was higher more than 90% of the time, the positive rate, more than 90% of the time, with only the year after the 1987 crash in red. So it might seem counterintuitive to most investors, but big rallies like we've seen tend to mark the start of a bull market, not the end. So I wouldn't be surprised if this bull market is not ending anytime soon. And we know that historically bull markets don't end in their second year. Almost no bull markets end in their second year. Keep that in mind as well. We've had historic breadth readings, right? Just last week, came into this week actually with the percentage of stocks trading above their 200-day moving average hitting 95%. Recently, I mean, that is just tremendous. It means everything's been in an uptrend and everything is at, you can make the argument, overextended levels. But looking back at 2004, recently more than 95% of the components in the S&P are trading above their 200-day moving average, a level that we have only seen 2 other times, in 2003 and in 2009, right? 2009, we were just, we made the March bottom in 2009. We made the March bottom in 2020. Looking back at 2004 and 2010, so that's a year, later than where this occurred, this, stocks trading above their 200-day moving average at 95% or better. 2004 did see consolidation a good part of the year, while 2010 had a well-deserved 16% correction after the huge gains off the 2009 lows. So again, expect choppiness, expect some type of corrective activity. You hear people all the time now, it's already priced in, it's priced in, it's priced in. You don't know what's priced in. Nobody knows what's priced in. You could have said that at 3,500, at 3,800, at 4,000 on the S&P, at 4,100. We're getting close to 4,200 now. Nobody knows what's priced in to any certain degree. But that doesn't mean you shouldn't expect some volatility, some speed bumps in the road. All right, the S&P 500 index performance after 85% of components are above their 200-day moving average. You tend to actually get better returns. 1 month later, 3 months later, 6 months later, and 12 months later. This chart right here is just your average returns over a month, 3 months, 6 months, and 12 months, dating back to 1950. But when you have 85% or better components above their 200-day moving average, the returns are a little bit better. So if we look at the 3-month return here, just any particular time frame, any particular year, it's 2.1% over a 3-month period. But when you have this many components above their 200, that much better breadth, it's 2.5%. 6 months, 4.3%, 4.9%. The 12-month return is where you start to get that separation in performance. 8.8%, 11.1% when you have strong breadth. Breadth matters, folks. It's validating the participation, the price in the S&P 500. I mean, people are still comparing today with 2000, right? Because this must be a bubble, right? But if you do study breadth, you're looking under the hood. You're looking for validation of price and participation. You know, you can see very clearly this is not like 2000. This is not like the 1997 run-up, you know, that 3-year period, that run-up into 2000. We had, for about 2 years, here's like in breadth, if you're looking at the 200-day moving average, the percent of stocks trading above their 200-day, it basically peaked in 1998. And for 2 years, it trended lower. We got to 35%. Only 35% of stocks were trading above their 200-day moving average in 2000. Like nothing was participating. It was just the mega cap names, or what became mega cap names during that dot-com boom, if you will. We have over 90% of stocks right now trading above their 200-day moving average. It is a very different landscape in the market right now than it was in 2000. I hate to burst the perma-bear bubble, but the current breadth looks nothing like that from the 2000 dot-com bubble bursting. All right, this chart right here from Bespoke Investment Group, S&P 500, you know, the spider, the historical chart here, just speaking to April. We know historically April's a strong month. Even after the strong March that we have, even after the strong first quarter that we have, if we just, you know, kind of narrowing our prism, if you will, to the month of April, we've gotten off to yet another good start for all of April. And stretching back to the end of March, when the U.S. equity market has been open, it doesn't go down. So if we've started in the green, we've ended in the green. It's been a very good month. The chart of SPY above shows the ETF is closed higher than it opened for 12 straight days until yesterday. So it ended a streak. Yesterday was the end of the streak. Yesterday we opened. Wednesday we opened higher. We made a new record high at 41.51 intraday, but we closed down almost 0.5% on the S&P. That was the end of this streak. So for 12 straight trading days, we closed higher than where we opened. In the history of the SPY ETF, or the S&P 500 Index ETF, stretching back more than 25 years, there has never been a longer streak of days where it closed higher than its opening price than what we just witnessed. So strength begets strength. We had a strong March. We had a strong first quarter. We're having, you know, this record, you know, setting event here already in April, but everybody's calling a top. Everybody's buying protection. How's that working out for you? Some breadth studies from Andrew Thrasher as well. This particular one looks at the percent above the 50-day moving average. Okay, the stocks trading above their 50-day moving average. Currently, coming into this week, 89% of stocks are above their 50-day moving average, with each prior occurrence of 85% or better marked by these blue lines. Like, this is more frequent than how many stocks we see trading above their 200-day moving average. Hence, a lot of blue lines here going all the way back to 2004. Notice the time's not showing at least 85% stocks above their 50-day. Major drawdowns like 2007, right? We had obviously a big drawdown then. 2011, we had almost a 20% correction. We came just shy of it. 2015, we had, I think, an 18% correction. 2018, we did have a technical bear market. We were down 20% intraday. And of course, 2020. So major drawdowns. Each of the largest drawdowns in the last 13 years had much lower market participation, though, than what we see in this breadth study. This doesn't mean we didn't see pullbacks when breadth was still strong. But just in 2010, did the S&P 500 see a material break under the 200-day moving average when stocks did pull back? The point is, when you have this many stocks trading above the 50-day moving average, you tend to not get those larger pullbacks because you have so many stocks in this uptrend. This breadth is so strong. You get these speed bumps, but not much more than that. Everybody's calling, they want a 10% correction. It's going to take a catalyst. It's not that you can't get one, but it needs a catalyst. That's why we highlight 2010, because we've been focusing on the 2009 into 2010 analog with the S&P 500 that has lined up so beautifully, since the March low. And here we're at the cusp of when you had that big drop in the S&P 500 in 2010. But people all of a sudden forget, we're supposed to be following the 2009-10 analog, so we're about to get this big drop. It took a catalyst because we had very good breadth in 2010. We had a flash crash. People all of a sudden, they forget what caused it. But then we put all of these mechanisms in place so that we don't have the same kind of issue in the future. We haven't had a flash crash since. So if we're going to deviate from the 2010 analog at this point, it might be because the flash crash potential is not there anymore because of the mechanisms that have been put in place. That doesn't mean we can't have another catalyst, something outside of a flash crash. Nonetheless, it's going to take a catalyst given that breadth is so strong, and that's what's basically being pointed out here in this chart study by Andrew Thrasher. And here's another one that points to sentiment. The 5-day average daily sentiment index for the NASDAQ is pretty extreme. But he's combining different sentiment indexes. He's combining the one for the NASDAQ, the S&P 500, and the Nikkei. And right now the reading of these DSIs, daily sentiment index, if you combine them together, is above 86.5. The 5-day average DSI percent bullish for the NASDAQ, S&P, and Nikkei indices currently average 86.5%. Fewer times that this has happened. They're all marked by the green lines here. Each time sentiment for this group of indices got frothy wasn't always followed by an immediate move lower in price. Not immediately. But we often saw less attractive price action to follow, especially over the last couple of years that this has happened. Ultimately, here's the key point. Prices do move higher. You get setbacks from time to time, like we did right here. They look like speed bumps, right? Like we did here. Speed bump here, 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 here. Here's a bigger speed bump, but price traveled higher regardless. That's the main point. Elevated sentiment, like in the first quarter of 2018, And people are also kind of saying this is like the melt up that we had in 2018. They were saying that going into February, right? But we had those speed bumps already. We had a 4.5% correction in January. From February into early March, we had a 5.8% correction on an intraday basis, not a closing basis, but on an intraday basis. Like, we have corrected here this year, but they just don't last long because, again, breadth is so strong. It's hard to keep a good stock down, a good market down. Something that, we're keeping a close eye on, of course, when it comes to a cap weighted index, the big five, right? The big five just haven't done well here this year. They've done better as of late. They are what led us out of, the bear market. But here this year, they've done a lot of nothing. What was brewing as risk last year, because if it was just the big five stocks, your big FANG, and maybe even add to that Microsoft, you'd have a problem. But everything else finally caught into gear basically in September, and then in October. Oh, I think we lost you there for a second, folks. All right, forgive me. Okay, here we go. So everything has come back here very well. Last year, the risk was if it was just going to be the big five, the FANG, and maybe Microsoft added, then we'd have problems with this market, continuing to drift higher. But that's just not the case. Small caps, value, cyclicals, they've been what's leading this market since September of last year. All right, so here's another breadth study. One of the things that you want to see, if the market's making new highs, naturally you want to see advanced decline lines supporting that or validating it. The S&P 500 cumulative advanced decline line. It did earlier this week. It didn't on Tuesday. It didn't yesterday. S&P 500 advanced decline line hasn't made a new high since Monday, but it can still make one here today. I mean, we're talking about it being that much off of its all-time high, why the S&P 500 is making new highs. So we look at other indicators like expansion of new highs, individual stock new highs. Earlier this year, we saw a contraction in new highs. But as of late, the end of March into April, we have an expansion of new highs signified by these green candles there. So is it a healthy bull market? Yes. Healthy bull markets have healthy amount of new highs. Seeing a steady expansion of new highs in recent weeks just kind of validates what we're seeing in price and what we've been seeing in a lot of other breadth indicators. When it comes to studies like this, unfortunately, in real time, this is terribly useless because you don't know when we're not going to see new highs, when stocks will start going down. They just do. But, in terms of doing your weekly due diligence and seeing if, price is diverging from breadth, this holds relevance. Here's the S&P 500. We talked about this chart in our weekly research report last Sunday. The reason why I highlighted it is because, once again, we are trading. The S&P 500 is trading about 2.5 standard deviations above its 50-day moving average. Usually you get some kind of consolidation of price once you stretch that far beyond the moving average. That's what the circles here signify. And you can see you get the price consolidation. And here we are coming into this week. So this is from our Sunday weekly research report. Bespoke Investment saw basically the same thing we were looking at. And this week they offered, their chart, basically the S&P 500 streaks of extreme overbought readings. Extreme overbought conditions are when the S&P 500 is 2 to 3 standard deviations above its 50-day moving average like it is right now. Yesterday, Wednesday, marked the 9th straight trading day that the S&P 500 finished in this overbought condition, as they call it. I call it overheated, overextended. I don't believe in the term overbought. If the market goes higher over time, how could it ever be overbought? some of the things that are said in the market become colloquialisms that don't have a lot of logic to it. But I digress. So this is now, however, when we look at the chart, this is now the longest streak since January of 2018 here that we've been in these kind of overheated, overextended conditions in the market. We would expect this to, result in some kind of consolidation near term, but that consolidation should be deemed opportunity. All right, we also talked about this chart last week in last week's State of the Market. This is the 618 or the 162% at Fibonacci extension level. Basically, it's the measured move from the bottom of the the bottom of the more recent bear market to present levels. And usually you do get some kind of consolidation once you've gotten to this 162% extension area. How much of we don't know. But history is your guide. It's about setting expectations and knowing the probabilities going forward. This chart right here, another example of a move from the bottom to the 162% extension level. This is from 1980-1982's bear market, the bear market bottom. And then you had this really sharp move over about a year's period. But then look what happens. Once you get to that 162% extension level, which is right here in the chart, we basically went nowhere for a year and a half. But then we made new highs and we were off to the races until about 1987. This was a really strong and long-lasting cyclical bull market there. Here's another example, 1987 crash, right? Here's the 87 crash. And it took, several years just to get back to the former highs and then to make get to the 162% extension, Fibonacci extension. And once we got there, we basically did nothing. We got here in late 1991. And then until about 1993, we finally broke out. So 91 through 92, all of 92, finally in 1993, we broke out and kept running. There again, that 162 extension. Here we are in 1998. We had this, basically the LTCM crisis, if you will, long-term capital management, as it's called. We had that big 22% drop. Rather quickly, we made it, to the 162% extension level. And that was it. Again, for a goodly period of time from basically mid-1999 to late 99, we went nowhere, finally broke out. And that, unfortunately, started the dot-com bubble bursting. 2015, the most recent example of, we had the drop in 2009. We finally got to the 162% extension level, and then we went nowhere until about mid 2016. We had the election, and then we took off throughout all of 2017 into 2018. Like, you get these consolidation periods, but then you get these really nice liftoffs, which teaches you it's about time in the market, not timing the market. Like, you have opportunities to buy and see another rip, buy and see another rip, and then rip that much more. There's always going to be opportunities. We're probably getting into that stage of the cycle where we're also mid-cycle, and it has been expedited, of course. Well, we're 1 year into this bull market, basically. How could we be mid-cycle already? Things have sped up quite a bit because of all the monetary and fiscal policies. Basically, just kind of plugging a hole that was the pandemic period. Last but not least, so if you look at within the 2009 to 2015 period, we had the 162% marked from the 2011 top right there, because this was the flash crash that I talked about earlier. So if you use that level and go to 162% extension, once again, we went sideways for basically 2 years and finally broke out here in 2012. This is the most recent occurrence. 2015 and the 2010 flash crash. Those are the most recent occurrences. And here's kind of the takeaway. Didn't really do anything until 2012, but when we did, double-digit year returns in 2012, double-digit returns in 2013, double-digit returns in 2014. Time in the market. Just stay in the market, folks. You're going to have speed bumps, but you've got to be willing. You have to have cash on the sidelines. It's more painful for people that are all in, so to speak, and they're not giving themselves the opportunity to benefit from when the market goes on sale. I was asked this week, what is a good percentage to be in cash? I think a good percentage, based on my experience, and I'm 22 years in the market, is about 25% in cash. You'll always have the opportunity to either dollar cost average or buy significant dips that way. What did happen yesterday? We talked about this with our Finom group members in the trading room. Because yesterday at 2 o'clock was the Beige Book. The Beige Book was released, and we had this huge drop. Just all of a sudden, markets just tanked. I mean, on a big volume spike also. That's what this circle down is. Down here, as you can see, this red bar, this red candle, this huge spike. This is just a one-day chart here. So what I point out is usually something like that needs a trigger. And it's usually an algorithm that is triggered. 2 o'clock, what happened yesterday? The Fed's Beige Book. Now, the Fed's Beige Book doesn't mean a whole hill of, it doesn't amount to a whole lot. I mean, we had the Fed meeting. We know what happened there. We had the Fed minutes that came out last week. Why the Fed Beige Book? I'll get into that as well. But that's exactly the time. Exactly 2 o'clock. This algorithm was triggered. And it must have been a big institution, because you're not going to get this kind of volume. How do we know it's an algorithm? Just because it drops? No. Algorithms tend to have what we call a three-wave pattern. And you can see it here in the chart. The first wave is the trigger. And it's usually where the most volume is generated. And then the algorithm basically times out. It's kind of drawing those dip buyers in, if you will. And when it doesn't sense that there's a certain, based on the code within the code and logic within the algorithm, if it doesn't stimulate an offsetting volume of buying pressure, it triggers the next wave. So you get what's called the body of the algorithm. And then that times out, and unfortunately people buy that dip, but not in volume, and you get the terminal wave, the third wave, which is the terminal wave. That basically is the culmination of that sell program, if you will. Typically, you'll get a nice reflexive bounce once that algorithm has been, terminated. But you also, if it happens late in the day, you tend to finish lower. And that's exactly what happened yesterday. It was the Beige Book. Algorithms tend to be coded to levels, price levels, or keywords. And you've seen it. We saw it 2018, 2019, right? Trade war. Anytime we had the word trade war, we saw some type of volatility in price action. It's the same thing, these big institutions. And this took a very large institutional algorithm to trigger this. What happened yesterday also was, and how do we know it's also institutional, is because this right here. This is the Fed's POMO schedule. Basically, they're quantitative easing when they're doing quantitative easing functions. POMO stands for Permanent Open Market Operations. And you can see here the dollar value that the Fed is going to be purchasing of Treasury coupons. Sometimes they're purchasing tips or other products, but most of the times it's Treasury coupons. Whenever you see this dollar value, though, so far since April when they started quantitative easing. So far, only 5 of these $12.825 billion days, it happened on 4/14 yesterday, only 5 of the 23 occasions, because this is a bi-weekly schedule here, only 5 of 23 occasions when the Fed is purchasing Treasury assets of $12.825 billion has the market been green. Only 5 of 23 occasions. The probability the market was going to be down yesterday was high, obviously. Institutions knew it as well. That's why they're usually, we don't know why. We don't have verification as to why the market is down on this particular day. There's theories that institutions are using the extra credit market liquidity to sell into. Again, it's just a thesis, though. We don't have any hard evidence. You'd have to take a survey. And I don't see any institutions lining up to say, yes, that's what we're doing, to kind of, let the cat out of the bag. So again, this is about knowing what's going on in the market. The more you know, the more you understand, the greater confidence you'll have when you see what happened yesterday. Was this a buy the dip opportunity? And I'll show you my tweet from yesterday. Remember, the equities were down, but what else was down? The dollar was down, bonds were down, gold and Bitcoin were down. Doesn't sound like a flight to safety to me. Not a fearful bout of consolidation today, in my opinion, or in my book, as I speak in Spanish here. This was my tweet after hours, after the markets closed yesterday. The dollar was down, bonds were down, gold and Bitcoin were down. Like, where's the flight to safety here? Again, knowing what's happening in the market. Something triggered this algorithm. It happened at 2 o'clock when the Beige Book came out. For whatever reason, this institution decided Beige Book, they'll tie it to that keyword because it'll make headlines and everything. And that's what triggers the algorithm. And it happens to happen on a day where you expect the market to be down, kind of sheltering this institution, if you will, because, it's only up 5, it's only flat to higher 5 times out of 23 on this particular POMO operation day. Again, just kind of knowing these nuances about the market again, and knowing that the different asset classes weren't sought after as a safe haven, kind of tells you, this wasn't a fearful, drawdown yesterday. You could have bought that dip. Maybe you should have bought that dip given price action here on Thursday. I also was asked this week about low trading volumes. As the market's drifting higher, we're actually seeing trading volumes taper off. That's what this chart is showing right here. So S&P 500 has rallied to record highs, but look at trading volumes here, folks. We basically peaked out in March. We had this really sharp, this was the whole GameStop and whatnot. But either way, we're trending lower basically since, the first quarter, all of the first quarter and into the new month. Here's some commentary on that. In the past, new market highs reached during the times of feeble trading volume has served as a sign that traders are not enthusiastic about a bull run. But equity analysts say the ongoing drop in volume may not signal a looming crash due to a variety of changes the market has seen, from an unprecedented short squeeze on troubled stocks this year to the nature of trading in 2021. Traditionally, new highs on light volume would be deemed a negative signal for the market, especially when active managers dominated trading. But that is not necessarily the case today, said Michael O'Rourke. He's the chief market strategist at Jones Trading. He says, so much of today's trading is passive investors or computer model driven. The deceleration of volume does not give a clear market signal whatsoever. Ben Snyder of Goldman Sachs said that the drop in trading volumes might reflect a near-term dearth of catalysts. Like what's the reason to buy at present? For active managers, active portfolio, what's the reason to buy? With pandemic stimulus efforts and mass vaccinations already priced in, there's that word, priced in already. Again, even the Goldman Sachs analyst doesn't know what's priced in, but nonetheless, this is what he says. Already priced in, the market's still waiting for the earnings season and the next fiscal package to take shape. Investors may simply be waiting on the sidelines. What I've always said is volume. Look, the market takes the stairs up and the elevator down. While that's a colloquialism, it's also a truism of markets. Why? Buying is a process. You're looking for value. You're starting to plot your points of entry. Then it has to hit those triggers for you to hit the buy button. It's a process. The process takes longer. Selling is not a process. It's generally an emotion. It's a lot quicker, especially when fear is in the market. That's why the market takes the elevator down, the stairs up. Tweet here also. This is like the focus today. People are worried about volume. People were worried about volume the very next day. When the market had bottomed on March 23rd and rallied on March 24th of 2020, they were talking, well, the market rallied on very light volume. Any excuse, for the market to go even lower back then. Here's a tweet from Stephen Place. Just a friendly reminder. Low volume rallies are not bearish. They haven't been bearish for a decade. The market melts up on low volume. It takes the elevator down on a higher volume. It is not unusual for trading volumes to fall as stocks rally, said Paul Schatz, president of Heritage Capital, in an interview. Stocks in volume typically only go up together when there is what Schatz called a mania event, such as the recent GameStop short squeeze, which is, there you go. Or the dot-com bubble in the late 1990s. So, contrary to popular belief, bull markets see declining volume as they mature. There's less and less people trading as the bull market matures. Why? Because there's more and more people going to work and they're just not focused on trading. They're passive investors at that point as well. All right, so moving on, volume is not something that you should really use as an indicator unless we are seeing trough levels. Volume as an indicator tends to do a better job of marking bottoms than they do tops or intermediate moves in the market. They're good bottom indicators, right? Because you see a climax on high volume, kind of that trough point in the market. Everybody's throwing the baby out with the bathwater. Capitulation, they call it. But when the market's trending up, volume's just an obligate. Just cast it away. Something that I've been focused on lately is the NYSE Summation Index. It's the McClellan Oscillator, McClellan Summation Index. Here's some definition of that here. We talked about this last week as well, so I don't want to bore anybody to tears, but I have been, I want to see, we've been making a series of lower highs here and lower lows in this particular breadth indicator focused on the New York Stock Exchange, right? And here is the more updated version. As of today, coming into today's trading session, you can see we are almost back to this level right here, just a shy under it, just shy of it as we came into the market today. So from just a week, this has gotten a lot better. Now you could have said, oh, we're getting a lot better breadth here, right? And then it just rolled over. Same thing here. Breadth's getting better and it rolled over. So what's different about it now? What leads me to believe that this time we may actually continue to see improvement and get to, levels up here? Well, I look at the MACD. The MACD here doesn't look at the spread right now in the MACD of the NYSE breadth indicator. It's a lot wider than it is here. And look how sharply it's moving up as well. So again, today we could possibly get above this level here. When I look at, let's see, Breadth is pretty good on the NYSE here today. We've got more advancers than decliners. We should see an uptick in this particular breadth indicator. So play it by ear. But that's what I want to see. And why? Again, breadth indicators tell you about future price. They tell you where we're probably going in the future. Here's a study on the NYSE. When it exceeds 900, we're almost at 700. We got 200 points to get to 900. But when it exceeds 900 for the first time in at least a month, and we haven't been at 900 since here in February. So when it exceeds 900 for the first time in a month, look at the forward returns, the average forward returns here. All positive. The percent rate, all positive. 1 week, 2 week, 1 month, 2 month, 3 months, 6 months, 1 year. Breadth. Breadth is a leading indicator of price. Good breadth leads to better price action. What if we get over 1,000, right? Because the last time we were also above 1,000 would be December of 2020 during the Santa Claus rally, if you will. December of 2020, we got above 1,000. I'm not saying we're going to get there, folks. I'm just saying, think ahead. Think ahead. Game plan. We have good breadth right now. Here's a study from Steve Depp. When we get above 1,000, when the NYSI crosses over 1,000, the S&P 500% positive rate is quite strong. 1 month, 2 month, 3 month, 4, 6, and 12. Look at the percent higher rate. 81% a month later. 87%, 81%. 4-month return. Still 75% of the time the market is positive. 93% over a 6-month period. It has never been down once it gets over 1,000, 12 months later. June of 2020, it also hit this mark. December of 2020, we'll find out. By June, the market is higher. Right now, we're obviously higher than where we were in June of 2020 and December of 2020. We'll see how this plays out a year later. But wouldn't it be great if once again we got over 1,000? I'm just hoping for 900 right now because this is a pretty good breadth as well. And, the percent positives here are very strong also going out a year. Rates, yields, we have a big drop in yields today. We're down more than 10 basis points today, even after all of that strong economic data, folks. Strong economic data. Yields are still dropping. Maybe it's seasonality, right? This tends to be the part of the time of the year where people start hunting for bonds. They want yield, if you will. And that's what this chart from LPL Financial basically signifies. May, the horizontal orange, I think it's orange, slashes right there are when yields are moving lower. Lower in June, lower in July, lower in August, lower. It doesn't start, picking up until October, and little changed over here at the end of the year. But this is the seasonal period where you tend to get an appetite for bonds. Bond prices move up, yields go lower. Today we're down 10 basis points. We're below 155, 1.55% on the 10-year yield. I haven't seen that in over a month, I think. Now, having said that, this came out just yesterday from LPL Financial, but I also get the same information from Morgan Stanley. I tweeted it out on Monday. Basically the same kind of study here about the seasonality when it comes to treasuries. But what I said was, this is a nominalistic period. Like, we are going to have a lot of treasury issuance, over the next several months. We're going to be, we have to sell our debt. So there's going to be a lot of issuance this go around that may not make these studies very relevant. We're in this anomalistic period when it comes to quantitative easing and, the need to sell debt in order to fund all the fiscal packages that we've generated year to date. So that's a wrap for this week's weekly state of the market. But don't lose sight, folks. Stay the course. Know that there's going to be bumps in the road. Know that when things look hopeless, the most valuable opportunities are presenting themselves to you. If not for anything else, but to overcome that hopelessness. You know, that's where I was as a teenager, as an adolescent. You know, by the time I was 25, I had to make a decision with my life. I had lost my father. In 2000, he passed away. Today's his birthday. That's why today's hard for me. I kept my daughter home to keep a smile around. She's the only thing that kind of makes me smile on days like this. My situation just seemed hopeless. I lost my father. I had to raise 2 kids, a 13-year-old sister, 17-year-old little brother. I didn't have the best discipline still. I had a road to choose, if not for their betterment, to make sure they were taken care of. It was my most valuable opportunity. So I look back on it and say, good job. You did good.